She had to go and do it. We were having a nice, quiet stock market with the lowest volatility in decades, and this little grandmother had to go and ruin the party. Hey, Courtney Smith here, and this is your weekly Tradesmith newsletter, bringing the hammer to the markets for over 45 years. What a Friday. What a Friday. But more important than Friday, of course, is this disclaimer, and you should memorize it. You should really understand it because there's a lot of truth in there. Okay, our little old grand lady, Janet Yellen, came out and said that the labor markets were so strong that the pressures were building up to raise interest rates, and that caused just about every market to move. Let's start with the stock market, but we're going to get into bonds. We're going to get into the dollar. We're going to get into all kinds of things, gold, because what she said changed everything. Let's take a look at what's going on here in the S&P 500. First of all, look at how that price moved. A big outside day, but it's an outside day down. We call that a key reversal. Now, one of the critical things that I talked about last week is I said that markets go in cycles. And after we go through a period of low volatility, and we were in a period of ultra low volatility, we would go into a period of high volatility. That period is now. And the downside is where that volatility is going to go. I'm now bearish right now. Let's take a look at that as well. So big changes. The punch bowl has been taken away by Janet Yellen, and we're about to have a correction in this market. Now, let's take a look. The low volatility gave way to a big outside day down on stronger volume. Notice that the volume was creeping up, not significantly, so we can't really say definitively, but I had pointed out the last couple of weeks, I think, how the volume was declining as the market was going up in a sluggish manner. And I told you that that was not confirming the bull market. I told you that the RSI, the green line, was not confirming the bull market and that divergences were in place. Now, those divergences are little divergences so that the market could just trade off for a few days. So we got to be honest, that's not a super bearish signal. But I think the fact that we made the lowest low in 3 weeks is significant. Let's keep going here. Here we see, we talked about this last week, the purple predictor was bearish on the Dow Jones. Look how it went down. It's showing the market was going to ready to crack. Momentum cracking. The leader was the NASDAQ. The NASDAQ has cracked. Seasonality, I'm going to still call it neutral at this point. Right now, actually, I think the seasonality picture is most likely the blue line. And the simple reason for that is because it has the most data behind it. And that suggests that we should see the market sell off 2 or 3% here through September and into early October. I believe that correction started Friday. Now, this is not the big one. This is not a major bear market. You can ignore the doom and gloomers. They don't know what they're talking about. They're always wrong. Yes, one of these days, even a blind squirrel finds a nut every so often, and they will be right one of these years. In the meantime, let's make money. So, my second best scenario is the green line, which is the seasonality if the incumbent party wins the presidential election. And that's exactly what I think is going to happen. I shouldn't say it. I'm not sure that that's what's going to happen. The betting, of course, is that Hillary will win. So I'm going to stick with the blue line for now, but we have to keep our eye on that green line as well as a potential rallying point. I'm not following it as closely as the blue line because there's just not that much data in it. So it's a little bit harder to draw a significant conclusion from it. But nonetheless, we've picked the 2 most bullish lines on the screen because they describe what's happened so far this year the best. Now, the yield curve still keeping a cap on prices. Asset allocation, who cares? It's just going sideways now for a month. Our stock market risk indicator slowly grinding higher. That is a little bit bullish. Global shares, though, cracked more than the U.S. markets. So we've got to start bailing out of those things even more than in the U.S. market. So I wanted you in Australia, time to get out. Look at the heavy volume. I told you to get into Japan. No, time to get out. Got to get out. Bonds. Now, we had a big range day. We went from the top of the pennant formation to the bottom of the pennant formation on heavy volume. Once again, a big key reversal to the downside. That's bearish. Also, we saw the RSI crack to a new low. It hasn't been this low since April. Okay? So, I've been telling you how I think this is going to probably crack to the downside. I'm getting more and more firm on that. Now, I don't want to sell a break of the pennant. I'm going to sell a break of the horizontal purple line. So around 137 and change on TLT is where I'm going to be a seller. I want it to break out of this trend. Out of this channel, I should say, out of this congestion, consolidation, and crack to the downside, and then I'm going to leap all over this thing. However, let's wait until then. And by the way, I think this is going to be one of the best trades of the year, and we got 5 more months to go. All right, bond key factors. Well, the top one is turning bearish. In other words, that interest rates will go lower, but the bottom 2 are moving higher. So net, I'm going to say this is bearish for bonds. Bearish for bonds. Now, the dollar, look at what it did. An even bigger move. Wow, explosion to the upside. It opens lower, cracks lower, turns around, and skyrockets higher, breaking the downtrend line. Got to be significant. However, I'm still not eager to trade the dollar here. I'm going to take a bullish stance, but I'm not happy about it because the reality is the market is in a big trading range that goes back to last March. So look for it now to go to the top end of the trading range. So is it a tradable trade? If you're a short-term trader, absolutely you should get long. Looking for 96.50 is the first upside objective and 97.50 is the second objective. But for position traders, just stand aside. US yen, look at that. We talked about that horizontal green. We talked about the red line first. Potential head and shoulders top. We cracked it, but couldn't break the lows. Now we're back up above the breakout level. So got to reverse our position there. Gold, look at this. Now, this was very fascinating to me. Look at what happened. It opens about unchanged. It skyrockets up and then turns around and closes about unchanged. So it's not as big a move as we saw in the dollar or the bonds or the stock market. But because the late price action was down, because we closed near the low of the day, you have to take this price action of the last 2 weeks as bearish. So I was getting all bulled up on gold, but I can't get long. I don't really want to go short because I do feel that some of the fundamentals are still bullish. But with the dollar skyrocketing and with bonds going down, that's not helping out our gold position at all. Well, we don't have a gold position, but I mean my gold opinion. So here it's suggesting bearish price action. Look at all of our indicators are now going down. And so that suggests that gold will go down. However, we're at the same price as we were in June. So we need to break through that 1310 level, that low that we made back in July before I'm going to start getting bearish. But if we break that, I want to be short. Okay, oil. I just want to shoot myself sometimes. Look, I'll be honest with you. I'm confused. I think that the fundamentals remain bearish. And I could go into long detail on why that is. But refiners are not making a lot of money right now. And they're the main determinants of the price of the demand for oil, I should say. We're also seeing we had seen a decrease in production, but we're starting to see an increase in production in OPEC. So it's just kind of a mess. Here's the thing. I think we broke down. We're now back up into the trading range that we were in May and June. And probably the best thing to do is to stand aside the oil market. Anyway, big changes this week. Janet spoke. She told us what she's going to do. She's not going to raise interest rates in September, which is the next meeting. Why? Because she doesn't want to be political. Raising interest rates would help out Trump. She was appointed by Obama. She is a Democrat. She's a lifelong Democrat. So she'll wait until after the election to raise interest rates. I've always been the biggest dove and thought that she wasn't going to raise interest rates in my lifetime. I was a little exaggerating there. But let's say that she's going to raise interest rates in December, 1 year after the last time she raised it. But definitely not in September. But now she's got the whole world having to adjust to the new rising rate environment in the United States. So that's what's going to dominate the market in the coming week. Hey, I know you want specific trade recommendations on how to make money from this. So go to that website up at the top, Weekly Market Forecast, but you go to bit.ly/weekly market forecast. And it is case sensitive. And then you'll get all the super cool stock and option recommendations for a peanut, less than a Starbucks coffee a day. I mean, really, which would you rather have? A Starbucks coffee or TradeSmith? I mean, the answer is obvious. With TradeSmith, you can make money to buy more Starbucks coffee. Buy yourself an espresso machine for at home. All right, everybody. Thanks very much for all you freebies. Love having you here. Fully paid up members, hang on just a second because I've got lots of new trades, including short trades to take advantage of this dip in the market that I see.